Okay, we're in session 13, capital markets. And we're going to be talking today about the 7A program. We might go further than that, but we're going to start off on it. So we're basically going through all of the different loan programs, exercises with the intention in mind, always to remember that you need to understand the programs so you can give appropriate advice solving problems. Okay. So, can anybody give me a high level overview of what the 7A program is?
So it's just a small business loan where there's less payment for less monthly payment because there's lower interest rates and longer terms and I forget what the rest is.
Well, let me say this. So, some of those are accurate. And so they're not necessarily true that you're lower interest rate. Could potentially be that way, but it's not necessarily true always. Okay, because you're always going to have a 25-year amortization on a 7A when it comes to real estate. Okay, when you're dealing with real estate, they're always going to do a 25-year amortization. When you deal with businesses, non-real estate stuff, how many years do you think they're going to do on amortization?
Yeah, non-real estate.
Non-real estate.
So like 10.
It is about 10. So it could be 7.
Yeah, 10 or 7.
7 to 10 years is kind of the range. Now, why do you think that they're doing a lower amortization on non-real estate assets?
Because they're not trying to get you to refinance.
No, not necessarily. The reason, well, so think about this. If you have a piece of real estate as your collateral, okay, are you more secured or less secured than non-real estate?
More secured.
You're more secured. That means that if you foreclose on that asset, you have something tangible that you can turn around. Lord willing, you're in the right economic environment and sell it and get most of your money back. Okay, so you're pretty secure. Now, if you come to me and I've got John's jumpy house business that I've set up, and I'm leasing space, then what are you securing against? What do you, because you're going to give me money, you're going to secure it with something. What are you securing it with? Because remember, they file liens, right? You're either doing a first deed of trust or you're doing, remember, UCC filings. And what are you securing in those things, those assets? You're attaching yourself to something.
You're saying like out of John's like business, no real estate involved.
So my John's jumpy house business that I have, it's not, there's no real estate, but in my business, I've got a bunch of jumpy houses. I've got.
So just all your assets?
Yeah, all my assets, which are basically jumpy houses. They're the blow up things. Maybe I have some equipment in there that's furniture and fixtures and stuff like that. Mm-hmm. But here's the question. If you give me a $500,000 loan, I have to purchase all this stuff. Do you think that stuff is really worth $500,000 2 years later?
No.
Because like equipment and all these little jumpy houses get the living tar beat out of them from all these kids jumping all over the place, right? And so, they're getting holes punched in them, and they're beat up and their life cycle just kind of goes down fast, okay? So if I'm lending you money, then I'm saying to myself, look, why would I drag this loan out for 25 years when your asset is like 3, I mean, it's like, and then that thing is probably having to be replaced, chances are, maybe, and so I'm trying to accelerate that principle by shrinking, okay, the amortization. So I'm going to hammer at that loan to get it paid down as fast as possible, so that I don't get into a position in 3 years where all of a sudden your loan is still this much and my stuff is worth this, right? Does that make sense?
Mhm.
So that's the distinction between the non-real estate and the real estate, okay? Now, what index does a 7A lender use to price their loans? They use one index every single time. Do you remember what it is to price their loans?
Is it the one you pulled up last time?
It was on there.
Um,
Sounds like
sounds like I'm.
yeah. Starts with a P. Sounds like Right.
Oh,
Right. So Wall Street Journal Prime. Okay, so remember, think about the Fed. The Fed has been jumping that Wall Street Journal Prime. Okay, so remember Prime right now, if you look at the rates today, Prime is essentially going up. So 6.25. 6.25. Remember, now Prime got all the way down to like 2.25 or something. It was low. Okay, so Prime has been jacking itself up because that's the index the Fed uses to price things. To pull money back in, push money back out. So if they're trying to take liquidity out of the market, they're going to do what? Increase the rate, right? If they're trying to get liquidity in the market, what are they going to do?
Use it.
Goes lower.
yeah.
Because you and I borrow money if it's cheap.
Yeah.
If I can go get a car loan for 0% interest, I'm like, sign me up, right? I'll start spending money. So, so Prime is the index they use, okay, to price their loans. And what do they do with Prime?
Besides like using it as a standard to price their loan.
They use it as a standard price, but what do they do in order to get to their all-in interest rate?
They look at the yields.
Well, they take Prime plus what?
The premium.
They Prime plus a spread.
Right.
Okay, so a spread over Prime is what they're trying to use in order to get an all-in rate. Do you remember what the max they can charge on the spread? Do you guys remember what an index is? What's an
Yeah.
index?
Just, I guess it's a standard for the banks or the lenders to go off of to price the loan.
Then what do they usually do on top of that? They add what?
A premium.
Premium
Or-
spread, right?
Yeah,
A spread or premium on top of that in order to get to the all-in rate. So the federal government says that if you're going to do prime on a 7A, the max spread you can charge is 2.75. Okay, so you cannot go 2.75 any greater than that, over that. So if you had 6 1/4 today, what would be your all-in rate at 2.75 over the prime rate?
can you say that again?
So what is your all-in rate at prime plus a spread of 2.75? And prime is 6 1/4. 6.25.
Just 9.25.
That's right. So I don't even know. So if you take 6.25 plus, that's 9, right? So 9% is your all-in rate.
And that spread, the 2.75 spread, that is only on 7A loans? Or is that,
Yeah, correct. Meaning that the max they can do is 2.7.
okay,
Yeah. It's a federal mandate. You can't do any higher. So you have this all-in rate of 2.75, and it's a 6 1/4. Now remember something, that if they do a floating rate, okay, so if they say we're going to float your rate, how often can that rate change? So if they're going to float your rate, meaning it's a floating interest rate, how often can it change?
Every year.
is that annually? Or is it just whatever the period is?
Well, how often does prime change? Can it change? According to the Fed. Remember, because you have the Fed,
Monthly?
huh?
Is it monthly?
Quarterly.
Quarterly?
For the federal funds meets every quarter to determine whether they're going to raise the interest rates. Okay. It's important for you guys to understand how the banking system works, right? That's how we're determining the money supply. The M1, M2 that goes in and out of the system is through the Fed, right? And they're the ones that are going to tell you whether our interest rates, we're dealing with inflation. We're dealing with this right now, inflation, right? This is all of a sudden going up dramatically. Okay, so they keep jacking those up so they can try to slow the economy down, slow spending down. So this is what they're doing, okay? So you take that 6 1/4 plus a spread, and if it changes every quarter, then that's when they could readjust. Now, is it always going to go up?
No.
Could go down. They could come back. I don't think they're going to be doing that anytime soon, but they could come back and say, we're lowering it 1%. So now you're at 5 1/4 plus the 2.75. Okay. Does that make sense?
Yeah.
Yeah. So just remember that. Okay. So they could also fix it. So someone could say, we're going to do a spread of 2 over prime, and we're going to fix the rate for 5 years. and we're gonna do on a 25-year amortization. So the loan would still, so my question to you guys is, do 7A loans actually balloon ever? Remember what I mean by a balloon? What do I mean by a balloon payment?
Is that a second payment?
It's not a second payment. Remember, you have a term or a balloon. What does that mean?
Is it kind of like a prepayment? Like you pay early before? No.
Nope. A term is meaning the loan comes to maturity. Okay, means the loan matures at that date.
Oh, so like with the SBA loan or the 7A, you have like 25-year. Let's say you do 15 years. So at that 10-year point, you're just paying that remaining amount off.
That's correct. So if I amortize it over 25 years, but my term is 10 years, when the 10th year comes, I have to pay it off. Or they refinance me again, okay? So that's what that means. Make sense? You guys tracking with me?
Yeah.
Okay. So a term, so my question to you is, can the 7A ever come to, does the 7A ever have a balloon payment before the 25th year?
Yes.
It's actually no, it's not.
Oh, really?
No, there's no term on well, there is a term. It's the 25 years. They never balloon, okay? So this loan goes all the way for the 25 years. Now it can fix for 10 years, or fix for 5 years, or fix for 15, but after that, it floats just until you get to the 25th year, okay? So there's never a maturity date other than the 25th year. That's what a 7A loan is, okay? Now, does it have a prepayment penalty?
Yes.
What is it? Does any of this stuff show on the video? Like the questions I'm asking at all? Like the prepayment penalty wasn't discussed, or the spread wasn't discussed, or anything?
I don't think so. I remember we watched it kind of early last week.
Okay, all right.
Yeah.
If it doesn't, then I need to change that.
Yeah. I think we remember talking about the 10, 9, 8, the countdown method, where like if it's 10 years out, it's 10%, 9 years
Well,
out,
that's the 504.
5.
That's the 504. But for the 7A, it's always a 5, 3, 1. Okay. So 5% in the first year, 3% in the second, 1% in the first. Okay. Or in the third, sorry. So 5%, what does that mean? 5%.
5% of the payoff amount.
Yep. So
So,
5,
so for example, say it's a 25-year loan. Anything after the 22nd year is all 1%.
actually, it's not. Anything after the third year is 0%.
Oh, so you just need to pay it for 3 years, and then after that, oh, that's not bad at all.
You can pay it
Okay.
off. Yeah.
Oh, okay.
Yeah. So after that period of time, it's 0% after the third year.
Okay.
Okay, so it's a 531 for the prepayment penalty. Now, was there anything discussed about the fees? Do you remember anything about the fees that get paid on the 7A? Do you remember that at all? If it was on there. So the 7A loan how much of a guarantee do they provide? Do you remember that? How much of a guarantee does the federal government provide to the bank to back it?
75%.
75%. Now, when we get into weird times like COVID, they actually increase that to 90 because they're trying to encourage people to, spend. So 75% is the normative. So what they do is they charge fees. Okay, so the government says we're going to charge you this sort of weird schedule of fees. So it's typically 2.5% of 75% of the loan amount. Okay, so let's just say your loan amount, take your calculators out. Let's just say your loan amount is $5 million, okay? So take 5 million times 75%, and what's that amount?
3.75 million.
So take that times by 2.5%.
93,750.
That's your fee, okay? That's a fee that gets tacked on top of the loan. So
Okay, so on top of interest, you also pay that amount.
that's correct. You don't cut a check at close, but it gets tacked on the loan. You're paying for it, you're just spreading it out. So technically, you're actually paying more than 93,000 because you're actually paying interest on the 93,000 over the life of the term. Okay. So there's these fees that come with it. The other thing to notate on a 7A is it is for real estate, and you can do non-real estate with it. Remember, the 504 does not do non-real estate.
Mm-hmm.
Okay? It only does tangible assets, hard assets. And so you can't get working capital with a 504. You can get working capital with a 7A. This is basically a line of credit. But it's not really a line of credit, they just give you the money. So that's the other thing to be cognizant of. If you could put it for any of those things, buying a business, buying out a partner, buying equipment, getting a line of credit, all those things. Okay? There's a downside. There's lots of downsides as far as I'm concerned. But there is a downside that becomes very problematic for most people, but a lot of people don't like it. They come to you and say to you, Ben, we're going to lend you the money and I'm going to give you 90%. But you're purchasing it for 10 million bucks and you're going to get a 90% loan. Okay. So it's 9 million bucks. Now, I'm discounting the property by 20%. Okay. So you just put 10% down. So now you've got this deficiency of another $1 million. Even though that's not happening in real life, they're discounting the property by 20%. And you just put down 10%. You have a deficiency of another 10%. And they're okay, go ahead.
They're discounting it from 10 million. They're saying it's worth 8 million instead of 10 million.
Correct. The SBA government says we are going to discount that on paper. On paper. So now we believe it's worth 8. So we need to shore up the difference between your, I used a pretty high example for the sake of effect.
Yeah. So why would they not have had the loan secured before they purchased? Like, how would they have been able to purchase it to begin with for 10 million?
Well, this is all happening all during the underwriting.
Okay.
See what I'm saying? So like, let's use another example. Say you purchase for $1 million. Okay. So you're purchasing $1,000,000, the loan is 900,000. So which means you're putting down how much?
You're putting down 100,000.
$100,000. Now they're going to take the purchase price of $1,000,000 and they're going to discount it by 20%. So what did they think the building's worth now?
Now I think it's worth 800,000.
Now, the government isn't physically doing this. This is just part of their backwards underwriting that they do. And they say, since you're putting 10 and we're 10 even below that, that's an additional $100,000 of deficiency that you have in this loan right now. And we want to shore it up with additional collateral. Okay, so that additional deficiency. Now there's two ways you could do it. There's a couple ways you could do it. You could put down another 10% and now you don't have any additional collateral. Or they can take a lien on your securities that you have. Say you have $300,000 in stocks, they could do that. Or if you have equity in your house. Okay, so all of a sudden, let's say you have a couple $100,000 of equity in your house. Then they will take a second behind your first on your house. You guys tracking with me?
Mm-hmm.
So what happens is, let's say that your house is worth $500,000 and you owe 200 grand. Okay. So you've got 300 grand of equity. Their test is to say, if you have 20% or more equity in your home, we're taking a lien. If you don't have 20% or more equity, we won't take anything. So if you don't have it, they don't take it. If you do, they do. Okay. It's just how they operate. And so people don't like the fact that the government is going to take a lien on their house, a second lien, essentially. And by the way, it's for the life of the loan. So, unless you pay it off, it's for the whole life of the loan. That makes sense? Okay.
Mm-hmm.
Yeah. So, so that's kind of what it is. So you tracking with me? So this is part of the 7A loan that, we go through, okay? So, so the 7A loan is for business owners. You have to occupy 51% of the building. So if you don't occupy 51%, they're not going to give you a loan, okay?
That's only if you're going the real estate route with it.
Say that again.
That's only if it's real estate, like if it's non-real estate.
Correct. Well, I mean, either way, if it's real estate or non-real estate, you have to take 51%. So because they need to know that they're lending to a business that the majority of their, sort of collateral position is for something that is a business and not, hey, I'm taking 10% and then I'm renting the rest of it out. Because that just becomes an investment property. Does that make sense? Yeah, they want to know that they're lending to a business owner. Okay.
What was the other part of the video that made the percentage up into I think it was either the 70s or 80s?
Yeah, good question. If you're constructing a building, then you have to start off at 60, and within about a year period, they are basically going to say you need to occupy about 80%. And so it starts getting kind of funky. Okay.
Mm-hmm.
So that's kind of, how it sort of lays out. So you got to occupy the building 51%. It's for small business owners. You can do all these different things with it: collateral, non-collateral, working capital. It's based on prime plus a spread. You can't go higher than 2.75. You can float it or fix it. It never matures. They have hefty fees and they take liens on the property. Okay, but the positive is they'll do what? They'll go up to 90%. Okay. The reason I laugh about it is because if I'm taking a lien on your house, technically it's not really 90%. Okay, so, but you know, again, conceptually, they're doing that. Okay. And obviously, you know, it's for startups too. Startups can get them because again, they can do projections and they'll give you a startup loan. So it definitely serves a purpose in the economy for people to do it. Does that make sense?
Mhm.
Okay. So just sort of something to be aware of. All right. The other thing too is they take a long period of time. Okay, these take, you know, usually 60 to 90 days. They can be quite heavy. All right. So just something to be again aware of when all is said and done. Okay. So that's kind of the 7(a) loan in a nutshell. And they're again, they serve a purpose. They're good to have around, and you know, certainly it's stimulated a lot of people getting, you know, businesses and buildings. Okay. And what about the Freddie Mac program? What do you remember about the Freddie Mac?
It's a affordable housing loan for multifamily.
It is. It's affordable housing for multifamily. It is for that industry, for apartments, senior housing, things like that. Okay. And what are the kinds of things? Do you remember some of the program details?
Um, there's like there's like small balance, which was 7.5 million and below. I know they also did stuff with student housing, but they said they wanted a concentration below 25%, primarily undergrad versus grad students.
And do you remember some of the terms, like the origination terms, like what were the amortization?
Um, yeah, so small was non-recourse, 5, 7, and 10-year fixed products. And then there was also 20-year. I think it was 5 was 15%, 7 was 13, 10 was 10.
Correct. Yeah, so you can go, and do you remember what amortization they typically use on a Freddie Mac program?
Was it 20?
30.
30. Okay.
So they do a 30-year amortization. Okay. So 30-year amortization, 5, 7, or 10-year fixed. Okay. Do you remember what kind of prepayment penalty they typically use?
Yes. Um, never mind now, I don't know.
It's higher, right?
It's a yield maintenance.
Oh, so it's like if the yield is high, the prepayment penalty is low. The yield is low, the prepayment penalty is high. And if it stays the same, the
Generally speaking,
down.
rates go up. There is a potential for that to not come into effect. If it goes lower, then usually it's higher because again, you're paying less. Okay, so it means that if I'm the one lending you the money, then ultimately I'm just thinking to myself, if the rates go higher, I'm happy to have you pay me off because I'll just make more money. If the rates are lower, I don't want you to pay me off because I'm going to make less money. Okay, general theory. Doesn't work exactly that way. Okay, but it's non-recourse. It's non-recourse. And what are the fees that are paid? Do you remember some of the fees typically for the small balance?
I know there was a good faith deposit of like 10 to 12K.
12,500, okay? So $12,500, that could change, but ultimately that covers all your legal, your third-party reports, and they usually are quoting you at par. Okay, so they're gonna quote it at par to you, okay? So that's ultimately what they're doing. And, you know, do you remember about how much time it takes to close these loans?
Trying to think which one was which. Was this one 30 to 45 or was it like 60 to 75?
It's usually it could be 30 to 45 days.
Okay, it was 30 to 40.
So 30 to 45 days. Its origination is par, and you know, so those are the things. Okay. The other thing is, what are these typically for multifamily apartment complexes, generally speaking?
Sorry, what did you say? It went in and out for a second.
So the bulk, can you hear me okay?
Yeah, multifamily, 5 units plus. And some mixed use as well.
So multifamily and all over the country. It's the largest program for apartment complexes in the country. Okay, they do probably 65% of the business in the whole country. Just because their interest rates are the lowest in the whole country. That makes sense? Okay. So that the Freddie Mac program is the premier multifamily permanent, meaning they don't do construction except for FHAs and 21-4s, which are large construction projects that have to meet a very particular criteria. Okay, so that's what they're looking for. Okay, that makes sense?
Yeah.
So again, fast, low rates. Right now, because the interest rates have gone up so much, their volume is just dumped off the cliff. I mean, their rates are in the 6s right now. It's just hard to underwrite anything at 6 and 4. You know, you bought at a cap rate of 3 and you're trying to lend at 6, it just doesn't work. It's just tough to make sense. Put a lot of money in. So those are those types of programs. Okay. Life company loans are ultimately what? Tell me about life company loans.
I mean, life company loans are very conservative just because, you know, people paying for life insurance don't want their money just to go buy in a second. So 80% of their portfolio is concentrated of bonds, corporate and government bonds. And then that other 20% is where they're kind of looking for, I think it was called pop yields. So like an increase of interest rates in the like compared to bonds of 50 to 100 basis points. So 0.5% to 1%. And they're looking for a long-term investment horizon. So 10, 15, 7-year loans. They're typically non-recourse. And they're looking for a DSCR of 150 to 160.
Yes, correct. Good job. Yeah, so life insurance company loans are very conservative because, like you said, they manage other people's premiums. They can't afford to lose that money. They have to keep it nice and preserved. Because if there's ever a disaster, you and I call up and it's like, oops, sorry, I don't have the money. Okay, so they just want long-term stable cash flow. So and remember the 4 food groups they focus on?
Say that.
So the 4 food groups they focus on in terms of property types.
Yeah, it was like apartments, sometimes retail. Like storage facilities and office.
Yeah, so the 4 food groups they call are office, retail, industrial. Those are the 4 food groups. Did they do storage? Yes, they do storage. Do they do hotel? Yes, they do hotel. But the 4 main food groups are typically office, retail, industrial, multifamily. Now, self-storage kind of falls under industrial, although it's not like true industrial, but they will look at those, okay? 95% of the time. Now, do they do construction, life companies typically?
No.
They generally do not, okay? They generally do not. They are going to, you know, now I do have a couple life companies that do, but it's rare. It's very rare. Okay. They're usually just a permanent lender. And how do the life companies distribute the money? Do they do it generally directly themselves? Or who do they typically go through? Do you remember? Do you remember, Zach?
I feel like there's definitely another player for that here. Just
Say that again.
I feel like there is another player, but
Player. Do you remember what they're called? It's with the C. Correspondent. So a correspondent is somebody that has been designated to represent a life insurance company. They have set up to be able to service loans, so they can service these loans, and they will, ultimately originate them, okay, and they will service the loans and they will do all the inspections, okay. So that's what we're dealing with there, okay.
Also, what are delinquency rates?
Delinquency rates are, so say that again. What are the delinquency rates?
Yeah. What are, I know it was talking about like how in 08, life insurance companies were like extremely low, like 1%, and whereas typical delinquency rate for the market was like in the teens. I assume it has something to do with like risk and like loans going bad, but
Yeah, the delinquency rate, generally speaking, is pretty low for life insurance companies just because they are so conservative in their underwriting that they're generally going to be in the low, single digits. They don't lose money that often at all. It's a very rare occasion for them to lose money, just because they're so conservative and they don't want to take properties back. But so they do they do non-recourse typically? Do you remember that?
yes, typically non-recourse.
Typically non-recourse. And what's the time frame they usually are closing? Do you remember?
15, 25.
No, probably more like 45 to 60 days. So 45 to 60 days to close.
So what is like the real benefit of going with the life? And because it feels like they're looking for really good loans, and like I don't know, like I don't feel like it's necessarily a pull for you. You just get a lower rate or a higher rate, or
Yeah, the reason why you go for life insurance companies is they're typically going to be more competitive than a bank. They'll have lower rates. They'll offer non-recourse where a lot of banks won't. Most banks won't, I should say. And they'll fix it for a long period of time. Banks don't like fixing loans for 10 years just because it's risky for them. They're just not in that kind of business. So that's life company, and they just do large loans. They can do, 20, 30, 50, $100 million, you deal with New York Life, MetLife. These guys don't even touch anything unless it's like $30 million or higher.
Oh, really? Okay.
MetLife is in your backyard, their origination.
So they just have a pretty like structured underwriting process that they're like almost.
Yeah. Yeah, and so they're going to be fixing it for longer periods of time. They love investment properties. Banks don't love investment properties. They're regulated to be a kind of anti-investment properties. So they really love business owners, owner-occupied type of real estate. Now they'll do it, they're just not going to be as competitive. So life insurance companies are known to do permanent financing. They can't really compete with Fannie and Freddie, but they can compete on all the other asset types. Now, Fannie and Freddie's so high right now that they're actually able to be competitive, but usually they're not.
And this is real estate only.
Real estate only. Yep. They only do real estate. They're just kind of in their little box. So they typically are the just permanent type of lender. They just fit that box really, really well. Okay. CMBS loans. CMBS loans, what does that stand for?
Commercial mortgage-backed security.
Do you guys remember what that type of loan is? What's a CMBS?
I remember the process of like what exactly it is, but I don't necessarily understand the whole like the loan part of it.
So I want you to think of, CMBS is like a gigantic broker. Okay. So Merrill Lynch comes in, but they've got to, I'm not just like a standard broker. You got to have a lot of money. Okay. So they have this big balance sheet. They come in and say, we're going to book the loan, but we're going to sell it. Okay. And so they're going to book it with the intention of selling it to this large tranche that gets rated and sold. Okay. And so ultimately what they're doing is they're going to sell this to a third party who again is these B-piece buyers, life insurance companies, pension funds, all these different groups. Okay. And they're going to sell it to them with the intention in mind that they have priced it accordingly to where they want to buy it. Does that make sense? So it is, they are coming in and they are doing the 4 food groups: office, retail, industrial, multifamily. They will lend up to what? Do you remember? Typically, how high will they go on the loan to value?
75.
The video said the guy from, well, I forgot what it's called. Sling he said 73. But in one of the previous quizzes, it was 80.
Yeah, and it changes.
Yeah.
When things are going hot and heavy, it's 80. When like right now, you're lucky if you get 65. So
Oh, really?
yeah, it's but when things are going really hot, it's high. Okay. And so so they are the types of lenders. Do they do recourse or non-recourse?
Pretty sure it's non-recourse.
Non-recourse, 100% non-recourse every single time. Do they quote, is it expensive in the fee? Do you remember how much that is? Sorry, my lights just went out.
You're good.
There we go. I guess if you don't move enough in here, it shuts off. And it's hotter than a cow's nest in here because the AC. So is it how much is the fee? Do you remember? It's about 50 to 60 grand, and that's being nice.
Oh, yeah.
Sometimes it's higher. Okay. And what kind of amortization do they use?
They were 10.
That's,
10-year?
that's the maturity.
Okay.
It's not the amortization. It's 30 years.
30 years also.
So 30-year amortization, okay? So 30-year amortization, 10-year call. Do they do interest only? Sometimes. They may have not said this on the video, but they offer interest only sometimes on these loans, where they'll do an interest only loan for 5 to 10 years. Banks don't do that. They'll never do it. Well, I shouldn't say never. It's extremely rare. Okay. So they can provide interest only types of loans. Those are really positive things.
So is that like with no fees? It's just only interest?
Correct. There's no, remember you do principal and interest, you got principal and then you got the interest payment, right? And so you gotta figure that, you know, you're not having to pay the principal. So your loan's never paying down, but you have interest only, which means your payment in totality is what?
Just the interest.
Is the interest, which means that your cash flow is higher because you're not having to make the principal payment, right? So you're making more cash flow off of the property.
Okay. Okay. So
they like that. If you're a long-term holder, you're like, good, make more cash flow. So you get to take more money out of the property. Do you remember them talking about reserves? Remember that at all? Remember that, Zach? Okay, when you underwrite a loan, a lot of times they're going to underwrite to reserves. So they're going to underwrite to, you know, the fact that they're going to have like tenant improvements and leasing commissions, you know, replacement reserves, all these different things. In the underwriting section, they're going to underwrite as if you're going to have to replace tenants. So they're going to strip that off the cash flow. And in many instances, they'll impound for it. So you might have your payment, but then you have an additional tenant improvement and leasing commission you have to make into a bucket every single month, accruing so that if you ever lose a tenant, it's almost a forced savings program. Or replacement reserves, if all of a sudden they do a report and it looks like the roof is going to have to be replaced in 10 years, they're going to force you to save the money to replace that in 10 years. And it has to go into a savings account, okay? So that's the part people don't like, because it's kind of like saying, well, crap, I don't need a babysitter telling me that I have to, how to save my money. And they say, well, we're due non-recourse, so we have to take it back. We want to make sure the money's there, right? So that's the kinds of things they do. They do sometimes things called springing impounds, like if a big tenant's coming up in 5 or 10 years, they'll actually store money for that big tenant leaving. So there's all sorts of things they're trying to do to mitigate their stuff. Does that make sense?
Mm-hmm.
Good. So, so I think that's enough for today, okay? So we're done for today. So again, we're gonna finish this off next, well, not next session, which is Wednesday. We're gonna finish this off and so we can move on to the next section, which is gonna be the underwriting, okay? So that's really what we've got for today. So